934,000 people lost money on the same asset, in the same way, for largely the same reason, and almost none of them saw it coming. The NYT confirmed the total damage at $3.8 billion in retail losses from a single politically branded crypto token. Here is what that number does not tell you. The loss was not random. The structure that produced it was visible on-chain before most people bought in. So the real question this video answers is not what went wrong. It is why the signals were there and nobody acted on them. Start with the buyer profile, because the media narrative got it partially wrong. Coverage framed this as unsophisticated retail. People who had never touched crypto before, drawn in by political celebrity. That is true for a portion of buyers, but wallet analysis from on-chain forensics firms in early 2026 showed a meaningful cohort of mid-tier crypto holders, people with existing wallet histories, prior DeFi transactions, and demonstrable experience in token markets. These were not first-timers in every case, which makes the failure more instructive, not less. The token launched with an enormous asymmetric information problem baked directly into its structure. Approximately 80% of the total supply was concentrated among insider wallets at Genesis, a figure that was publicly readable on any block explorer within hours of launch. The standard retail due diligence checklist, check the team, read the white paper, look at social sentiment, completely misses this. None of those steps require you to open a block explorer and read a wallet distribution table. Most retail investors never do. This matters because the launch mechanics were not hidden. They were just encoded in a format that the average buyer does not know to check. Tokenomics transparency is theoretically a feature of public blockchains. In practice, it is only useful to people who know where to look and what concentrated supply curves actually mean for price action. The actionable insight here is straightforward. Before entering any token position, the first question is not the price chart. It is supply distribution. If more than 50% of supply sits in fewer than 10 wallets at launch, the exit liquidity math works against you by design. This is not a controversial take. It is arithmetic. Let us be precise about what was knowable and when, because this is where the story gets uncomfortable for anyone who is paying attention professionally. Within the first 48 hours of the token trading publicly, 3 distinct on-chain patterns were observable to anyone running basic analysis. First, wallet clustering. Multiple large insider wallets executing coordinated small cell transactions below reportable thresholds, a pattern associated with deliberate position unwinding, designed to avoid triggering large transaction alerts on exchange monitoring dashboards. Second, liquidity pool depth was thin, relative to the fully diluted market cap being cited in headlines. The ratio of actual liquid supply to quoted market cap was implying a valuation that could not withstand even moderate sell pressure from insider wallets. Third, the token velocity, how quickly units were changing hands, spiked in a pattern consistent with distribution rather than accumulation. Insiders moving supply to retail, not institutions building positions. None of this required proprietary data. Etherscan, Dune, analytics, dashboards, and publicly available DEX pool data showed all 3 signals. The problem is, signal access is not the same as signal literacy. The information existed in a format that required roughly intermediate-level on-chain analysis skill to interpret. For 934,000 buyers, that skill was not present. This is the gap that no regulator has closed, because it is not technically a disclosure failure. The data was public. The question is whether public disclosure that requires specialized technical knowledge to decode constitutes meaningful disclosure for retail investors. That debate is now front and center in congressional cryptocurrency framework discussions taking place in 2026, and the answer the market gets will define how the next version of this story plays out. The practical takeaway: if you cannot read a Dune dashboard, you should price that knowledge gap into your position sizing. Asymmetric information has a cost. In this case, it averaged roughly $4,000 per retail holder. This is the section most outlets avoided because it requires saying something most financial media is reluctant to print. Under existing U.S. law as of mid-2026, the structure of this token offering did not clearly constitute a securities violation. That legal ambiguity is not an accident. It is the product of a decade of regulatory inaction, jurisdictional turf disputes between the SEC and CFTC, and a political environment in which crypto-friendly legislation has advanced without equivalent investor protection provisions. Here is the regulatory architecture problem in plain terms. Securities law requires disclosure of material information by issuers selling investment contracts to the public. The Howey test, the 80-year-old legal framework used to determine whether something is a security, has been inconsistently applied to tokens. When the token in question is attached to a public figure rather than a company, when there is no explicit promise of profit, and when the sale is structured as a collectible or a cultural artifact rather than an investment instrument, enforcement becomes legally complicated. Prosecutors must prove intent and investor reliance, both of which are difficult to establish when the marketing was ambient cultural association rather than explicit yield promises. The result: $3.8 billion in documented losses, nearly 1 million affected investors, and no criminal charges filed as of the date of this video. Civil litigation is ongoing. The FTC has opened an inquiry. But the core transaction, issuing a token with 80% insider supply concentration and selling it to retail at peak hype, occupied a gray zone that existing statute did not clearly prohibit. This is not a defense of what happened. It is a description of the system as it actually operates, because understanding the real rules is the only basis for protecting yourself under them. The investor protection framework for tokenized assets remains incomplete. That gap will be filled eventually by legislation, by case law, or by another loss event large enough to force the issue. Until it is filled, the legal vacuum is the risk. Not financial advice. But if you are allocating to token markets in 2026, understanding what protections you do and do not have is not optional analysis. It is the foundation of any rational position. 934,000 people, $3.8 billion, and a structure that was readable on-chain before most of them bought in. The signals existed. The legal framework did not protect them, and the average loss was roughly $4,000 per holder. That is the closed loop. The open question now: the congressional token framework being debated this year, does it actually close the disclosure gap, or does it codify the same ambiguity with new branding? That is the next video. Subscribe to Synthetic Alpha so you do not miss it.